Dear investors, welcome to the April 2026 monthly roundup video. The Iran Israel US war is neither raising nor concluded. What politicians do, what motivates them is beyond my perception, and what benefit each side hopes to gain from the war is still questionable. All that can be seen is that Brent crude has breached $100 per barrel, and every country except maybe Russia is hurting, including United States, where the gasoline prices have gone up 50% from $3.15 to $4.55 per gallon now. India has so far been able to resist price hikes in petrol, diesel, and domestic LPG rates. If the Brent crude price doesn't settle below $80 by June end, then March to June quarter results would be hit hard, and so would India's current account deficit, GDP, and economic growth. The oil marketing companies are absorbing a lot of loss to the tune of 30,000 crore rupees a month because of the rise in crude oil prices, and this is not sustainable for longer. There is recent news that US and Iran are working on a one-page memorandum of understanding to either end the conflict or extend the ceasefire. The US is currently waiting for a response from the Iranian regime. Let's see what comes out of it. The share markets are in a rhyme of their own, with the Nifty 100 index rising 7%, the Nifty Midcap 150 index rising 14%, and the Nifty Small Cap 250 index rising 19% from April 1st till May 8th, 2026. In fact, the Midcap index made an all time high on 7th May. Three key things to observe here. Point number one, although large caps and hybrid funds are the safest and people take a lot of comfort in them when the markets fall, thinking that they are less volatile, their recovery is also slow and they can hurt your portfolio returns in the long run. So, right portfolio allocation is very essential to get optimized returns based on your risk profile. Point number two, mid caps and small caps have rallied a lot in the past 40 days, which shows that structurally the market has got strength and the rally is broad based. But large caps, especially banks, have to come in line to support the rally, else, the market could move sideways. The third and most important observation, when the share market goes through a period of extreme pessimism and low or zero returns, it is invariably followed by a phase of better than average returns. But there is no clear distinction between where the bear phase ends and the bull phase begins. The transition is often so seamless that the investors, retail as well as well informed institutional ones, are in doubt and disbelief in the initial phase of a bull run, and the price moves up 20 to 30%. When the investors get a feel of, okay, this could be the beginning of a bull phase, there comes a dip that bearish investors sitting on the sidelines believe is the breaking point of the market, and in a hurry to justify that they were right all along, miss this cheap entry point into the market. After this small blip or a series of blips where the market is forming a strong base, when the market resumes up move, it grabs the attention of many investors and specifically the media and influencers, and the return chasing starts. Bullish reports are published, economy news looks rosier, and corporate profits look better. News and social media start declaring this as a bull market like never before, and then the real participation begins when the market can move up 100 to 200% and even 500 to 600% from their low point. Huge sums of money flow in, and there is widespread euphoria. Valuation concerns are thrown out of the window, and everyone is buying as if there is no tomorrow. The market rises every week, every day, almost every month, and the buy side analysts come up with all sorts of reasoning to justify any kind of valuation. That's when the bull market has matured. Valuations have stretched way beyond fundamentals, but still, overconfidence makes investors complacent and every market dip is bought into. This further increases the wrongly placed confidence of investors in an already overheated market, the classic bull trap, where bullishness about price gets the better of you and one takes extremely risky bets, often leading to long term losses. Many people who invested in gold and silver in the month of January and February 2026 got trapped in this classic bull trap. At this point, an experienced or well guided investor would start reducing the high volatile positions in the market and reallocating their portfolio to low or medium volatile positions to lock in the gains and wait out the price erosion that is about to come. After a period of turbulence or stagnancy, the market reorients itself into a low valuation when silently the bull phase begins once again. What one thinks of the current market valuation will determine how much he or she is willing to invest and what kind of funds one will purchase. One thing that fascinates me so much about the market is at the same point in the market, one set of investors think the market is overvalued and other set of investors think the market is undervalued. And both have equally compelling reasons to justify their view. In the short term, the market is heavily influenced by the news flow, but in the long term, the market is a slave of earnings and economic development. Here is an interesting fact for you. As an investor, you are passive owners in the businesses as shareholders and not as promoters. The difference is huge. An investor never gets a share of the profit in the business or has a say in the day to day operations of the business. So, whether you are holding the shares through mutual funds or are buying them directly from your broker through the stock exchange, the valuation at which you enter and exit those shares or mutual funds will always determine the amount of returns you are going to make. Such a fundamental thing, but every investor misses it. Case in point, Hindustan Unilever. The share price of Hindustan Unilever went from 1512 rupees on 1st of May 2018 to 2268 rupees on 1st of May 2026 in a span of 8 years. So if somebody would have invested in lump sum in Hindustan Unilever in 1st of May 2018, they would have made a 50% absolute return in the past 8 years, which translates roughly to 5.2% compounded annual return. If we take the dividend yield of 1.8% and compound it over 8 years, then the total absolute return will be 66%, 50% from stock price appreciation plus 16% from dividend yield, which roughly translates to a 6.5% compounded annual return over past 8 years. But the profits of the company has increased 188% during the same 8 years from 5227 crores to 15059 crores, and earnings per share or EPS has increased 167% from rupees 24 to rupees 64, a nearly 14% compounded return in the past 8 years. So why is the share market return less than earnings? Any guesses? Because the valuation of Hindustan Unilever was higher in 2018 when one bought it and is lower now. So, investing in the share market, whether it's stocks or mutual funds, without taking valuation into consideration, can significantly impact your portfolio returns in the long run. Believe me when I say this, SIP is a tool to be disciplined in investing, but doing SIPs in mutual funds without any regard to valuation and portfolio allocation, and specifically not paying attention to the valuation when exiting any investment may lead to below average returns from your investments. So please consult your financial advisor before investing your hard earned money into the share market. Hope this video has been useful. Thank you. Happy investing.